You're listening to Strictly Business Podcast with Lindsay Williams.
Welcome to the Asset Class, and this podcast is proudly brought to you by sharenet.co.za. Joining me today in the morning in the United States is Peter D. Schiff, who's the CEO and Chief Global Strategist at Euro-Pacific Capital, which is a division of Alliance Global Partners. At the end of the quarter, it's quite appropriate to speak to you, Peter, because at the end of the last quarter, i.e. at the end of December, you must have been quite excited with the S&P having lost around about 9%, and it could have been something that led to something, but it didn't lead to anything apart from a dramatic V-shaped bounce back. Were you surprised?
Well, I wasn't surprised that the market recovered. I think the recovery is a little bit more than I expected, but I did expect that when the Fed stepped up to save the market, which is something that I had forecast they would do for years, I also said that it would create a bounce. Had the Federal Reserve not done a complete 180 and called off all future rate hikes and basically said that they're not actually going to shrink their balance sheet, something they had been pretending they were going to do for years, we would not have had that recovery. The market would probably be on new lows right now. But because the Fed capitulated to the markets and did what I've been saying they would do for years, we had a bounce. But I think it's a bear market rally, so I wouldn't get too excited about it if you're long the U.S. stock market.
Yeah, I've always used the analogy of a volcano. The bear market is a volcano. It lies dormant for years and years and years, and you get the occasional spew out of ash and steam, etc., and then it goes quiet again. We had that in February, I think, last year when the Facebook story started to break, and then we had it in December when there was a little bit more of an eruption. Now it's gone quiet again, but the really big blow-off is yet to come. We'll get to whether it's going to come sooner rather than later on, but you have always said that the Fed is going to revert to quantitative easing and easier interest rates. And do you think they're compounding their woes and the market's woes by doing so, or potentially doing so?
Well, in the long run, of course, but in the short run, it's pretty much the only game in town to try to artificially stimulate the economy or the markets. I do think that the U.S. economy is headed for recession, probably this year, maybe at the latest next year. But even if we're not in recession this year, the growth is going to be much, much slower than it was last year. Last year it was 2.9%, which matches the growth rate from 2015. But the main difference is the U.S. national debt increased by $850 billion in 2015, which is a large number, except that last year the debt increased by $1.5 trillion. So we borrowed a lot more money than we had economic growth. So we're poorer than we were at the beginning of the year, not richer. So the growth is just an illusion created by debt. But the debt can never be repaid, and it can only be serviced to the extent that interest rates are practically zero. But I think that when the Fed has to go back to zero and they go back to quantitative easing, which I expect to happen maybe before the end of this calendar year, if not next year. But when the Fed has to go back to it, I think the next time the dollar is going to fall through the floor. Because what propped up the dollar the last time the Fed did this was the false belief that A, it was going to work and really cause economic growth, but B, that the Federal Reserve would be able to exit the policy and reverse what it had done, that it would be able to normalize interest rates and shrink their balance sheet back down to where it was before the emergency, before the '08 crisis. Well, I knew that was not true from the beginning. I knew it was impossible for the Fed to ever do what it was pretending it was going to do, but the markets believed the Fed. Well, the next time, I don't think there's any way anybody is going to be dumb enough to believe the Fed, because when we go back to zero again and the national debt goes from 22 trillion to 30 trillion or higher, and then the Fed says, well, we're going to normalize interest rates, if they couldn't do it with a $22 trillion national debt, there's no way they're going to do it with a $30 trillion national debt. And if they couldn't shrink a $4 trillion balance sheet, how are they going to shrink an $8 trillion balance sheet? Because the next round of quantitative easing is going to have to be much bigger than the last few, because the debts are much larger. We're running right now $1.5 trillion a year of red ink. That's more debt than we had during the depths of the Great Recession. That means during the next recession, we're going to have budget deficits of $2 to $3 trillion a year. That means the Fed is going to have to be buying, $3 trillion worth of treasuries every year. So, the balance sheet is going to blow up to new highs, and it'll be impossible to shrink it. So when people realize that this is a permanent source of financing, that America is just a gigantic banana republic, that we're just going to keep on printing money forever to monetize ever-growing U.S. government debt, and that interest rates could never rise because we're too broke to afford to pay it, then that's it for the dollar. There'll be a run on the currency. I think it's going to lose its reserve currency status, and I think we're going to have a dollar crisis and a sovereign debt crisis that will make the 2008 financial crisis look like a Sunday school picnic.
I spoke to somebody in London at a very large asset management company who spoke to me for about 20 minutes very passionately about the fact that the US dollar is going to lose its reserve status and it's going to be the Chinese currency that takes over. But to be fair, Peter, you've been calling the demise of the dollar for quite a long time now, and I'm looking at the US dollar at 112.30, 112.35 against the euro, and it hasn't happened. I've been speaking to people over the years that have consistently said, well, this debt situation, it can't be sustainable in the United States, but somehow it is sustainable. So when's it going to break?
Yeah. Well, I think, as I said, the reason last time, based on quantitative easing and 0% rates, was because of the delusion that this stuff was temporary. And the markets began seeing beyond the 0% rates and the quantitative easing, and they were looking forward to the rate normalization and the wind down of the balance sheet. And so since markets are forward-looking, the dollar began to price in all of that activity that people expected. Well, none of it is going to happen, right? The traders bought the rumor, but there's never going to be a fact. In fact, what's going to happen is the Fed's going to go back to zero and do more QE, and then the pretense is going to be gone. And so there is not going to be, something to look forward to where the Fed gets us out of this. It's, we're in a monetary roach motel, which is what I said from the very beginning back in 2009 when the Fed did this. I said that this is a huge mistake. They're never going to be able to reverse this policy, and I'm going to be proven right. But, I think that if you remember back in 2011 when the price of gold got to $1,900 an ounce, there were a lot of people who were worried that quantitative easing was going to end badly, and they were correct, and they were right to buy gold. It's just that for a while, people started to believe that everything was going to end well, and the people who were worried about inflation and worried about a falling dollar were wrong. Well, they're right. They're just right later because the world was willing to continue to buy dollars based on these false expectations. But the bigger problem is because the dollar crisis didn't happen years ago, because we kicked the can down the road, the problems have gotten much bigger. We've been able to borrow even more money. We've gotten ourselves into deeper debt. And so the U.S. economy is even more screwed up now than it was then, more dependent on cheap money now than ever before. And so when it's taken away, the collapse is going to be a lot bigger. So, I think that this is going to be, the final chapter in this. I don't see a way out of this next recession. So the next time the Fed has to do this is going to be the last because there's no way that the dollar can survive it.
Okay, the next recession, is it being predicted by the inverted yield curve? Are you an inverted yield curvist?
Well, the yield curve is inverting, but, I don't think it's going to stay inverted because I do think that people are making a mistake in the bond markets. I think they're correct in anticipating a recession. They're right. They've got that part right. The U.S. economy is headed for recession, and they're right that the Fed is going to start cutting rates and buying more bonds. But where they're wrong is that none of this is positive for U.S. Treasuries because ultimately all U.S. Treasuries are promises to pay dollars in the future. And when we have this next recession and the budget deficit skyrockets to $2-3 trillion a year and the government is issuing bonds in vast quantities, and then the Federal Reserve is printing massive amounts of dollars to buy the debt, right? The dollar is going to start collapsing. U.S. inflation is going to start rising substantially, and nobody is going to want to buy a 10-year or 30-year Treasury yielding 2-3% when inflation in the United States maybe is 5 to 10% or more. If the dollar is depreciating by 10 or 15% a year, who is going to want to lend money for such a low rate of interest? Nobody. Right? Massive deficits, skyrocket budget deficits and trade deficits, rising inflation, and money printing is not positive for your bond market. Right? That's how bond markets collapse. That's how currencies collapse. So people are not thinking far enough in advance. They're looking one move ahead, not 2 or 3 moves ahead. to see the end game for the Treasury market, because the only asset that's going to lose more value than U.S. dollars are U.S. Treasuries, because they're not dollars today, they're dollars to be paid in the future. And those dollars will be worth even less than the dollars you have today.
Let's talk about a currency that isn't a currency. It's called gold. And I got a little bit disturbed over the last few days because the gold price went from $13.25 US dollars an ounce down to $12.85. And I thought, well, maybe that sort of little tiny rally that gave us so much hope is now out of the window. But I got solace, Peter Schiff, from a chap that has been someone who's hated gold over the last couple of decades. But he said, Lindsay, I've just bought some bars of gold, and I'm putting them in a vault in a Swiss bank, and I'm going to continue to buy those bars because they can't take those bars away from me. They can take my financial assets away from me, my derivatives assets away from me, but they can't take away my gold bars. Maybe it's because he's getting old and cranky, but maybe he's right.
Well, yeah. Well, in order to take your gold, they have to find where you have it. So it's a lot harder to find your gold than your financial assets that are kept, with third parties that are easily identified. But, gold has been trending higher, especially if you measure it in currencies that are not the dollar. I mean, gold has been rising in most currencies quite nicely over the last several years, but it's going to rise sharply against the dollar once, the dollar, bulls capitulate. And, yesterday gold was down like $20 because we had a bump in the dollar, although now we have more weak economic data that came out today. And so the gold is rising on the back of that. But the data in the U.S. is getting weaker and weaker and weaker. And at some point, people are going to acknowledge the reality that the Fed's, halting of rate hikes isn't going to prevent the recession from coming. It isn't going to prevent the bear market from coming. That's what everybody believes. I think, now that the Fed is our friend, we've got the Powell put, everything is great. But it's not about the rate hikes in the future. It's about the rate hikes of the past. The economy can't afford the rate hikes that have already taken place because we have too much debt. And so when it was at zero, it was one thing. But now that we have rates at 2.5, and you have higher mortgage rates, higher credit card rates, higher auto loan rates, the U.S. economy can't afford it. U.S. consumers can't afford it. They're broke. They have record credit card debt, record auto debt, record student loans. That's why consumer spending dropped last month for the first time in like 3 years, and it barely recovered the subsequent month. Consumers don't have any money anymore because they're too busy paying off the debts from the stuff they bought in the past to have any money left over to buy stuff now. And corporations are levered to the hilt. The U.S. government has never had this much debt. U.S. states and municipalities, all the years of 0% interest rates, we had a debt orgy, right? Companies kept borrowing and borrowing money because it was so cheap to do so, but they weren't worried. They weren't thinking about the long run, about A, having to pay the money back, or B, how hard it would be to service it once interest rates normalized or even just got higher. The burden would be much higher. So when people really start to appreciate the severity of this problem, then I think you're going to see the price of gold go much, much higher. And you said earlier that somebody you were talking to thought that the Chinese RMB, might end up supplanting the dollar as the world reserve currency.
Yep.
My personal view is that there will not be a new reserve currency. The world will simply go back to the system that existed prior to the U.S. dollar becoming the reserve currency. And it wasn't the British pound. I mean, the British pound was the most dominant currency, but it wasn't the reserve currency the way the dollar is. The reserve was gold. Every country had gold backing up its currency. That's what gave it value. It was the gold that backed it up. What happened was after the Second World War, America was at the zenith of its economic and military power. We owned almost all the gold in the world. We earned that gold by running huge trade surpluses with the rest of the world, who didn't have the goods to pay for our exports, so they paid for it with gold. So America had all the gold. We were the dominant economy in the world, and the dollar was not only backed by gold, but redeemable in gold. You could take your dollars to the United States, and they would give you gold. In fact, the Federal Reserve note was not a dollar. The Federal Reserve note was a promise to pay dollars. The actual dollars were the gold. That's what the dollar is. It was defined as a weight of gold. So the dollar is a way to measure a quantity of gold. And so if you had a Federal Reserve note, you had an IOU for dollars. And so the world accepted the dollar or the Federal Reserve note as the reserve because it was as good as gold. Because whenever you wanted your gold, all you had to do was take those notes to the United States and they would give you gold. But of course, in the 60s, we started printing a lot of money to run what was considered back then big deficits. By today's standards, it was nothing. But we ran these deficits to fight the Vietnam War and the war on poverty and the Great Society and the moon mission and all this stuff. We started running deficits and we started printing more money or paper than we had gold to back it up. And the world started demanding their gold, and we defaulted on our commitment to pay it and basically declared bankruptcy. And we told everybody, you're not getting any dollars for your notes. You can circulate these Federal Reserve notes if you want, but we're not going to cash them. It's like a check, and they said, well, there's no money in the bank, but you can circulate the checks if you want, but we're never going to make them good. But the dollar, became the reserve currency. But I think what's going to happen is we're going to go back to gold. We're going to have real money as the reserve, and foreign central banks, which really don't own much gold today. Historically, they have very low, small quantities. Central banks are going to be buying as much gold as they can to shore up their currencies and to instill confidence in the value of those currencies. Because ultimately, once the dollar goes, what's to prevent people from losing confidence in the euro or the yen or any of these fiat currencies? Intrinsically, they have no value. And so you need to back it by something real. And, the only thing that I think people would have confidence in would be gold.
Peter, you're enigmatic but very exhausting as well. But I want to just sum it up now. And I say I'm sort of, after the last 15 minutes or so, I've got your portfolio in my mind now. You're long of bonds, in other words, short the yield. You're long of gold and always have been. And you're probably short the S&P via some long-dated puts. Can you correct me on that?
Well, I'm not really short U.S. stocks because I do believe they're going to go down, but I believe the dollar will ultimately go down a lot more. So when you're shorting stocks, you're going long the dollar. So if you look at what I own, yes, I do own gold and silver, and I own mining stocks, but I also own stocks in other countries because I think as the dollar goes down, you're going to see sharp increases, obviously, in other currencies. And so I want to own assets in those countries. And I think, too, when the dollar goes down, it's going to create a real economic boom outside the United States because the biggest problem in the world is the overvalued dollar and the cost that the world has to bear to support the United States, because the world has to lend us a lot of money that we never repay, and they have to supply us with all sorts of merchandise that we can't pay for. So the world has to expend great resources, land, labor, and capital, producing things for American consumers, and they never get paid. And they have to divert savings that might otherwise have been invested productively in their local economies, and they have to continue to lend it to the United States so that we can squander it on consumption. And so when the dollar collapses and the world, backs away from this arrangement, it's very bad for the United States, but it's very good for the rest of the world because that burden is relieved. And the world doesn't have to live beneath its means anymore to enable the United States to live above its means. So I have a lot of stocks that I own around the world in countries that I like, and I have portfolios that I think are going to end up delivering tremendous value to investors who are in front of this wave and are going to be on the receiving end of what will be a gigantic transfer of wealth and purchasing power away from holders of dollars and U.S.-denominated assets to holders of other currencies and assets in other countries. So, I've got clients all around the world. If anybody is interested in looking into what they're doing, they can contact us at, Euro Pacific Capital or, Euro Pacific Asset Management is the company here in Puerto Rico where I manage all the portfolios for people.
We'll come up to your context right at the end now, but the final question is, I bet you mentioned the word squander, but you don't squander your money, knowing you as I do. Having met you and spoken to you over the years, I bet you don't squander your money on South African mining stocks, despite the fact they've done well in rand terms anyway. You don't like South African mining stocks, do you?
Well, I do have a couple of positions there, but much lower weighting than I had, let's say, 10, 12 years ago, based on the government there. I mean, that is the problem. There's a socialist government, a redistributive government. I don't have a lot of confidence in property rights and the rule of law there. So it's just not a place that you're really comfortable investing large sums of money. Now, some of the South African companies have split up and their mines are no longer in South Africa. And so and those securities maybe are a little bit better because they're a little bit out of harm's way. But yeah, South Africa used to be the world's largest producer of gold, and it probably still would be the world's largest producer of gold if you didn't have the current government, if you had more freedom and less government and rule of law, and if you didn't have mob rule like you have today, you would have a much stronger mining industry and, of course, a much stronger economy. You'd have a much higher standard of living. People would have higher incomes. I mean, more people would be trying to move to South Africa instead of leaving South Africa. It's very sad what's happened to that country. And, what's even sadder to me is, the world, so condemned the apartheid government, and there was all these boycotts and sanctions but now that you have the ANC in charge and the economy is much worse, the oppression is much worse, the lives of the people is much worse, particularly black South Africans who are suffering far more today. But because their oppressors are also black, nobody cares. And so the world is quite content with having, completely destroyed South Africa. Not that I'm a big fan of apartheid, but I'm obviously a big critic of what replaced it, which is worse, which is generally the case, But now the world is, very comfortable with what they've, the destruction that has happened over there, because they can sit on their, high horse and pretend that, oh, we're so caring and we just, we don't like racism, whatever they want to pretend, and talk about how good they are. But they really have no perception of the harm that has been done as a result of their pressure.
Peter, even after what you just said, many people may want to contact you. So tell us how we do so, please.
Yeah, well, people can obviously just listen to my podcast at schiffradio.com or on my YouTube channel, but they can contact me by utilizing my website at europac.com. EUROPAC.com or EuroPacificFunds.com, and there's a way to to contact me there. Or just call the phone number that's on the website.
Peter, thanks so much for your time. That was Peter Schiff, who's the CEO and Chief Global Strategist at Euro-Pacific Capital, which is a division of Alliance Global Partners. That podcast was proudly brought to you in association with ShareNet.co.za.